doesn't look like people were very excited about Alphabet's current results in Q2 that they recently put out. However, I don't actually think that the results were that bad, and there's a lot to be proud of if you're a shareholder in this company. So that's what we're going to dive into in this video. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in that chat. You're watching More Money. Let's get it. What's up, guys? And let's dive right into this one because I am a huge fan of Alphabet. I'm not yet a shareholder, but I do believe that before the end of this year, I will be a shareholder of Alphabet. I'm waiting for the shares to drop a little bit more. They've come down a lot. I'm also watching Microsoft because those shares have come down a lot. So I'm just biding my time here, but I do expect that I'm going to be buying into these securities. Now, that's not a recommendation for you to go out and buy. Do your own research, but that's just kind of how I'm thinking about this right now. Now, let's dive right into this. So note that the Wall Street Journal reported that Google's sales growth slowed as there's pressures on the ad market. And I just put a comment on the top left here that digital ad spend is slowing, but look for a slight boost with political ad spend in the back half of this year. And why am I saying that? Well, because this is, in my opinion, going to be a very contentious midterm elections. I think there's going to be a lot of money on the line for advertising here. And so advertising companies, including digital ad spend, will get a boost that they didn't experience in the last year. And so there will be a bit of a reprieve here, but I think overall digital ad spend is going to be challenged in this environment as the consumer pulls back. And you can see here CNBC reported that the company actually missed earnings per share at $1.21 versus $1.28 as expected. But seriously, who cares what the sell side analysts were expecting? At the end of the day, the sell side analysts have a 1-year target price on the name, and we tend to value companies on an intrinsic value perspective. Now, look, I'm not dogging sell-side analysts at all. In fact, I used to be a sell-side analyst. That's where I got my training. And I do acknowledge from my experience, when you speak to these sell-side analysts, which I had access to all of them, they are some of the smartest people that you will run into. But that being said, the nature of their recommendations is that they put out a 1-year forecast. So just keep that in mind when you see that the companies are missing analyst expectations. So what exactly happened? Well, you can see here that revenues are actually up 13%. And that's actually higher than my personal fiscal year 2022 expectations of 10%. So just putting that into perspective. But note that their CEO, Sundar Pichai, did say that in the second quarter, our performance was driven by search and cloud. And you're going to see that when I show you the analysis. The investments that they made over the years in AI and computing are helping to make their services particularly valuable for consumers and highly effective for businesses of all sizes. So that's a lot of good news, or good wording at least, but you'll see that some areas of their business were challenged, including ad spending. So you can see here that search actually grew 13.5% versus what I was kind of expecting for at least for the year of 2022 of 15%. So they still have time to catch up. They might catch up a little bit due to political ad spending, but I just don't know if it ends the year at 15%. It might end the year a little bit lower, which is fine. It's a high watermark. YouTube, I actually expected a lot of growth on YouTube. And so the fact that it's 4.8% year over year versus my expectation for the full year of 2022 of 30%, it's a huge decline. But note that a lot of political ad spending does happen on video formats. And so that could be a huge pickup for YouTube. And it's something that could help us get closer to that 30% watermark that I have sort of etched in for the remainder of 2022. I actually think that it's very likely that they don't get to that number as well. So just take that with a grain of salt. Let me know in the comments where you think YouTube ends up by the end of the year. And you can see that a big winner here was Google Cloud. They're actually up 36% year over year on the quarter versus my expectation of 25%. Now, I actually think Google Cloud could potentially slow as the year goes on. And so I'm going to keep my forecast at 25% overall. So in other words, it's not really changing my overall valuation for the cloud business. Now, overall, Alphabet's revenues grew at just over 13%, and I was forecasting around 17% for the year. I don't think they actually do come in at 17% for the year. And so I will take down my expectations a little bit for 2022. But what I think is a risk with my valuation, I will show you later on, is that my back years like subsequent to 2024 might be growing a little bit too small for this company, which is impacting my valuation. Now, revenue is just one part of the story. Notice that their 27.9% profitability remains strong, with cloud really helping the fact that they have slightly reduced profitability in service. So although it's not comforting seeing ad spend profitability decline, it's also not unexpected in this environment. And so that's something that I want to keep an eye on in Q3 and Q4, but it's really good news to see that cloud's profitability is increasing, which is offsetting some of the profitability decline in Google services. Now, the other thing is, as ad spend is expected to increase in the back half of this year, and video ads generally have a higher margin or higher profitability, we could see that overall Alphabet might come under on revenue, but in line or potentially over on operating income. So that's potentially what could happen. We'll see how it sort of plays out at the end of the day. But like I always say, this is just one turn around the sun. 1 year's results don't necessarily make up the valuation. And so I will show you what my model looks like at the end. And so it does come down to what exactly the model is forecasting a few years out. And so the first question is, what did they provide in terms of their revenue guidance for the rest of the year? And you can see that Alphabet didn't actually provide a revenue forecast, but analysts are expecting growth for the year of approximately 14%, or $293.9 billion in revenue. And so where do I fall with respect to where the analysts are coming in? Well, it's kind of eerie how close I am. And I didn't do that on purpose because I build up my segments segment by segment, but you can see that my total revenues at the bottom there are $293 million, or 13.7% growth. So that's pretty bang on with what analysts are expecting. And that's kind of crazy. I usually don't fall in line with the analysts that much, but here we go. So I think overall, we're going to see much of the investment community continue to revise their fiscal year 2022 revenues down. I know I have. The concern with my model is that I might be too conservative beyond 2024. Look at what I'm doing here. So I've brought down YouTube ads to around 20% growth, and I continue to grow cloud at 20%. And I actually think cloud could potentially pick up. In fact, I give cloud 25% in 2022, and then I drop that down to 20% thereafter. That might be too slow. I think cloud could potentially be growing at 25%. So there is a little bit of conservatism in my model. And so, especially because the conservatism is beyond 2024, I could be undervaluing this company. And so just take that into account when you create your own models. Also, better yet, tell me what growth levels you're forecasting the segments at. What am I missing? And so what does this mean for my valuation? Well, you can see that my valuation, I'm valuing the company at approximately $175 per share, whether you use an EPS methodology or free cash flow per share methodology. And so the company is currently trading at approximately 60% of its intrinsic value. And so it's pretty cheap. Now, I do believe that as ad spending continues to get impacted in this environment, the share prices for these companies could potentially continue to decline. So there could be some really good opportunities to pick up Alphabet much cheaper than it's currently trading at. However, if you're interested in them, it's not a bad time to buy an exceptional company at 60% of what its intrinsic value is. But once again, that's not a financial recommendation. Always do your work and talk to an investment advisor if you can. Now, if you want access to my model, you can get access to everything at that lower tier of the Patreons. And if you want to join us for a live epic presentation that we have every month, you can join us at that upper tier. Now, the digital ad spend industry is not the only industry that is experiencing pain right now. New home buying is actually struggling at the moment with cancellations on the rise. And I actually talk about that in this video right here.